In the last few weeks, the gold market has gone completely wild. Gold prices experienced one of the sharpest drops in decades. In mid-March 2026, gold plunged nearly 10% in just a few trading days, falling from above $5,100 down to the $4,100 to $4,400 range. When you include silver, the combined precious metals market lost trillions in value almost overnight. Then, almost as dramatically, gold staged a sharp rebound, climbing back toward the $4,900 level within days. Some investors panic-sold the bottom. Others rushed in to buy the dip. The divide in the market has rarely been this extreme. So here's the question on everyone's mind right now. Has gold finally bottomed? Or is this just the beginning of even more violent swings ahead? Let's be honest. The reason gold is swinging so violently is because it had run up extremely far, extremely fast, and the tension had been building for months. Any small trigger can now cause an avalanche. There are several reasons behind this wild move. First, gold had simply gone up too far, too fast. A lot of investors decided it was time to take profits and get out. Second, there's growing speculation about the next U.S. administration's policies. The leading candidate is known as a strong dollar hawk. His plan involves shrinking the size of dollar assets in the system to reduce liquidity. In simple terms, that means selling dollars and sucking liquidity out of the market, which is naturally very bearish for gold. But the real immediate trigger came from the futures exchanges themselves. In late January, major exchanges, especially the CME in Chicago, significantly raised margin requirements for gold futures, increasing the initial margin from 6% to 8%. Let me explain why this mattered so much. Most of the short-term price action in gold isn't driven by people walking into stores and buying physical bars. The real price discovery happens in the futures market, and futures are highly leveraged. With only 6% margin, traders could control $1 million worth of gold with just $60,000 of their own money. That's over 16 times leverage. When the exchange raised the margin to 8%, suddenly traders needed $80,000 instead of $60,000 for the same position. That meant a lot of leveraged long positions got margin called as prices dropped. Forced selling snowballed, triggering a classic cascade of liquidations. Whether gold has bottomed or not in the short term, one thing is becoming increasingly clear. The world is slowly diversifying away from the dollar. Central banks continue to buy gold at a strong pace, and trust in the long-term stability of traditional fiat systems is being tested. Let's step back and look at the bigger picture. For thousands of years, every currency in history has existed to price one thing: human labor. But now we have a new form of labor: artificial intelligence. AI doesn't eat, doesn't sleep, and can be copied infinitely. The price of this new labor is measured in AI tokens, and right now, only a handful of companies control the infrastructure to create these tokens: Google, Microsoft, Amazon, Meta, and soon, Oracle. They're spending insane amounts of money building the new Mint, massive data centers, GPU clusters, and even nuclear power plants to keep the machines running 24/7. This is the real story behind the gold volatility. While the world watches the Middle East conflict and worries about oil and weapons, the real battle for the future is quietly being fought over who controls the right to create the next form of money. The companies that win this race won't just be tech giants. They will become the central banks of the AI age. That's why gold is swinging so violently. The old monetary system is under pressure, and a new one is being built in real time. The violent moves we're seeing right now aren't necessarily the end of the gold bull market. They may just be the painful but necessary shakeout before the next leg higher. What do you think? Is this violent correction a healthy reset or the start of something more serious? Drop your thoughts in the comments below. If you found this helpful, please hit the like button and subscribe for more straight-talking market analysis. I'll see you in the next one.